So we move to Chapter 2, Elements of Financial Statements and the Double Entry. Again, an important area for us. This whole area of double entry, as I've mentioned from the outset, is key to your success in the exam. Let's take a look at the first area. And what this pertains to is really the idea that really the reason behind double entry is the production of statements. In the first instance, the statement of financial position. Now, from our sort of opening chapter, you'll be familiar with the statement of financial position is just simply really the idea that we own things or we owe things. And really, this statement, which is at a particular point in time, references assets versus liabilities. So let's take a look at assets. What do we mean by an asset? Well, IAS 1, International Accounting Standard 1, references as follows. Really, we're talking about a present economic resource controlled by the entity due to past events and has the potential to produce economic benefits. Now that's quite a mouthful, really, isn't it? Let's break it down a little bit. The first key point for me is a resource. This is something that you're going to use, and in addition, that you control it. Okay? Let me give you a simple example of maybe a resource that you use that you don't control. Staff. Because staff can come and go. While it's a resource, you can't control staff. You can't stop staff leaving perhaps at the end of the year or the end of the quarter. So certainly staff are not an asset. We need to be able to use it as a resource. We need to control it due to past events, i.e. we purchased it. And indeed, we hope that this particular resource has the potential to produce economic benefit. If it doesn't, then it doesn't meet the definition of being an asset. So what might be typically something that is a resource controlled due to past events that will produce economic benefits? Equipment, a factory, a building, etc., etc. Now, in terms of the sort of split of assets, we'll note from the statement of financial position, the top part, that really there's two main types of asset. There are current assets, and indeed there are non-current assets. Let's focus in on current assets. What we're talking about is assets that can be converted into cash or used within the next 12 months. Now that's important because the FA examiner is going to play tricks on you in relation to different types of assets, in relation to dates. We're specifically pigeonholing assets that are current with their use or their ability to be used or converted into cash within 12 months. Second area is just some examples, and we'll see from the face of the balance sheet that this current asset area includes a myriad of different things. Cash at bank is only one. Amounts due from customers, normally known as accounts receivable, is two. There are others, for example, stock. Stock is a current asset. And you'll know that each of those things would normally be expected to be used or consumed within the next 12 months. That's for sure. What about non-current assets? Well, again, they sort of do what they say on the tin. Non-current assets, it's more than 12 months. So we're talking about things like equipment, as mentioned up top, perhaps a building, etc. Now, in terms of examples, warehouses, delivery vehicles, other forms of equipment, computer equipment, etc., etc. In terms of the types, well, really, two main types. And again, this is important. We'll see reference to this later on in the course. The areas that we've discussed so far in terms of non-current assets have been very much tangible. In other words, you can touch them, you can feel them. I can touch a computer equipment, I can touch a car, a building, etc. So really, tangible non-current assets, they are assets with a physical form. You can see them and touch them. Now, you can also have intangible assets, which do not have a physical form. For example, something like goodwill, perhaps a patent, a license, etc. So let's note, just because you can't physically touch, see it, feel it, doesn't mean it's not a non-current asset. It could be an intangible non-current assets. Now, indeed, the rules differ between sort of recognition and indeed capitalizing tangible versus intangible assets. They're not relevant for this particular chapter. Let's just note that so far all that we've touched on is two different types of tangible non-current assets, or non-current assets, and indeed the fact that we can also have current assets which have a shorter time frame. Let's move on to liabilities now. I guess in one sense, the sort of reverse of an asset. We're talking about some sort of obligation rather than something that you own, or resource that you used, that requires some sort of transfer of economic value or a resource as a result of past events. You've incurred a liability. You've purchased an item on credit, let's say. You haven't paid for it. There's a liability coming up in 30 days, 60 days, or whatever. Or you have been to the bank, taken out a loan, you've created a liability of $1 million. That will be repaid over the course of time, perhaps monthly, quarterly, etc. So that is certainly an obligation in the future as a result of something that you've done to really pay out, to offset this liability. Similarly with assets, two main areas for us. Current liabilities, so falling due note within 1 year, or if you will, 12 months of the reporting date. By reporting date, we mean the accounting date. Let's say 31st of December, 2024, okay? In terms of examples, let's say amounts due to suppliers, sometimes referred to as accounts receivable or trade creditors. Invariably, they won't be waiting for more than 12 months. They'll want to be paid in 30 days, 60 days, etc. What about non-current liabilities? Again, similar to what we saw up top, 1 year beyond the reporting date. In terms of typical examples, well, various things, e.g., let's say a bank loan, a long-term loan for 5 years, 10 years, 12 years, or whatever, or maybe some sort of hire purchase agreement. I mean, certainly there will be payments due within the next 12 months, but what we're talking about here with non-current liabilities is the element that's due outside of the 12-month period. Okay? Let's move on from there. In terms of capital and equity, we know that business owners have a side or a slice to the business. Where you have a sole trader or partnerships, it would be termed capital. Where you have limited liability companies, let's say private or listed, it would be termed equity. So what is this? Well, we're really saying the residual interest. In other words, what's owing to the owners, either in the form of capital or indeed equity. Outside of that, how would you get to the figure? Well, if you take off all liabilities from total assets, you're going to get the difference. You're going to get the capital, or you're going to get the equity. There's a simple way of really looking at the sort of net worth of the business. In terms of our final point here, this net worth, if we were to value a business and to say, okay, this particular business, I have their accounts, I'd like to know what they're worth. Well, as we saw from point 2, what they're worth must be the difference between total assets and indeed total liabilities. But there's another thing that's not relevant to a set of accounts as we see them, that's not shown really. It would be perhaps some intangible, e.g., let's say, goodwill. So when you're looking at a business, you look at a balance sheet and say, okay, well, there's the assets, they're $1 million. There's the liabilities, they're 500,000. Therefore, the net worth of this business is 500,000. Well, technically, yes, based on the numbers. But, a business is worth as much as someone is prepared to pay for it. And that may well include things like goodwill, which could be, brand, it could be their reputation, it could be their locations, things that aren't actually shown as assets in the business. So watch for that.